Hi, everyone. Welcome to the Meet the Visionaries podcast, brought to you by the MIT Center for Real Estate. My name is Dean Feruzian, and I'm a current master's student in the Real Estate Development Program. This month, we have the pleasure of sitting down with AJ Jackson, president of Leo Impact Capital. Leo is an investment management platform focused on the creation, operation, and preservation of affordable workforce housing in the DC metro area. Leo is a subsidiary of JBG Smith, where AJ serves as Executive Vice President of Social Impact. AJ's track record includes extended tenures in both the public and private sectors, previously serving on the Executive Committee at the GSA as Chief of Staff, as well as Managing Partner at EYA in Washington, D.C. In addition to his day-to-day, AJ serves on multiple advisory councils and committees, as well as his contributions as a board member of Center Creek Capital Group and for Up for Growth. We're grateful to have AJ here with us today. AJ, would love to start off by introducing this concept of workforce housing. We hear on and on about affordable housing and affordability. Why is there such an urgency to address this housing crisis as it pertains to the missing middle?
Well, I think that last term, missing middle, really kind of captures it. There are a lot of programs and support, not enough, but a lot for folks at lower incomes. And then there's obviously the market, which is serves the market. But in the middle is a group of folks who generally earn too much to qualify for federally subsidized housing, but not enough to be well housed and well located in the housing that's provided in the market. And so that missing middle band has really not been directly addressed historically in housing policy. And we can see ramifications for that, particularly in large and growing cities where we have increases in low-income populations, increases in very high-income populations, and actually declines in the number of middle-income households that are able to live in those locations. So that has all kind of knock-on effects around transportation and the environment and quality of life and stress and education, et cetera.
Yeah, so I think alluding to that, you're definitely seeing this issue in the DMV and similar gateway cities with high growth economic considerations and trends. Can similar trends constrain other growth markets? And what are the unique economic conditions that can result in these types of constraints? Are we subject to seeing this same issue in other markets around the country?
We definitely are seeing it in multiple markets around the country. The Joint Center for Housing Studies right down the road at Harvard recently put out a paper on middle income renters in particular, and there are about 4.5 million rent burdened middle income households, meaning people that pay more than 30% of their income towards their housing costs, which is the standard for being rent burdened. So that's about a third of all of the middle income renters in the country are rent burdened at this point. So that gives you sort of a sense of the scope of the problem. And in some of the fastest growing parts of the country, particularly in the Sun Belt and Southeast, that rent burden level is over 40%, right? So 4 out of every 10 of these renters are burdened. And so we are seeing it in multiple markets. We see it on the West Coast in extremes. We see it obviously in a place like Boston as well. A factor that is not limited to DC, and it's really not even limited to large cities anymore. And it's a result of a long-running undersupply of new rental housing combined with actually a loss of stock of the housing that would be what we call naturally affordable, or NOAA, that would be affordable in that middle income band. UCLA several years ago did an analysis and that found that about 100,000 units a year or so of that naturally affordable rental housing are lost either to conversion through value add conversions to luxury product or to demolition and redevelopment of the stock. And so that's really the key issue, is not enough new building and a loss of existing supply.
A lot of states and municipalities are finding creative solutions for increasing the affordable housing stock, providing credits, social impact bonds, pilot programs are pretty common. I know in DC there's discussion on TIF financing. What are some of the public and private partnerships and strategies that you've seen rolled out with the most success, and what economic conditions are required to ensure those programs become successful?
We think one of the most effective public policy tools that can be used is real property tax relief, whether it's abatement or reduction. It's very efficient. It's very quick, and it can be tied directly to certain income levels or to whatever other policy objectives you want to achieve. And one of the real benefits of the property tax relief is that cutting taxes, which are often the second or third largest expense in any operating pro forma, is a direct boost to NOI, which then allows essentially that subsidy to be leveraged, because boosting NOI obviously boosts the supportable debt load of a property. And so you're essentially, we like to say, getting, the GSEs, Fannie Mae and Freddie Mac, to help you subsidize workforce housing if you're a jurisdiction. I will say one of the keys, though, to effective property tax relief, particularly when you're talking about trying to preserve existing naturally affordable housing, is that it has to be underwritable and predictable. So we work very closely with a range of jurisdictions to try to bake this type of tax relief into statute, because that way the senior lenders can underwrite it at the time of acquisition, and we can get the benefit again of those increased debt proceeds, which are really the greatest power that subsidy has. If it's not predictable and underwritable, if it has to be negotiated on a deal by deal basis, oftentimes it can't come soon enough to be a part of the underwriting for the senior mortgage when we're doing an acquisition. Because when you're buying existing assets and trying to preserve their affordability, you're in competition with value add investors in an open market, and you're typically looking at something that you're going to go through, a 45 to 60 day study period and a 45 to 60 day closing period. You don't have the months and months and months that you have in conventional affordable housing to work through, a long closing process and a detailed subsidy negotiation. But that's one of the most effective tools. There are other tools that jurisdictions have used. California has been particularly effective in using tax-exempt bond financing in partnership with these what they call joint powers authorities in the state of California to acquire housing and keep it affordable. And Texas has been particularly effective with its public facilities program. And then we've also seen in Florida some really creative legislation for new production of middle income housing, workforce housing, in the state of Florida by relaxing zoning requirements and expanding the ability to build housing targeting that middle income bracket on almost any parcel of land in the state.
Yeah, you alluding to this idea of sustainable financing and making sure that the underwriting can be kind of guaranteed, or you can have some level of support and ensuring that financing is there. It kind of leads into this topic of Leo Capital and how you all have positioned the organization, positioned Washington Housing Initiative and many of the investment vehicles within JBG Smith to compete in the private markets as an affordable and workforce housing operator. So Leo Impact Capital was formed as a subsidiary of JBG Smith, and as EVP of Social Impact, your leadership included the direction for all of the impact vehicles, including the Impact Pool and Washington Housing Initiative. So, what was the firm's initial strategy in spinning off Leo, and how does this change the game as it pertains to private investments in affordable and workforce housing?
Well, after we created the Washington Housing Initiative back in 2018 and raised an initial fund and grew that business really from a concept to a portfolio of over 3,000 units, we wanted to keep going. We saw that there were additional opportunities to create and preserve affordability in the middle income band. And we also realized that the business had grown to a scale that it needed its own identity, partially as a way to create clarity in the marketplace, both from an investor perspective, but also from an investment perspective, between this impact-focused business of JBG and the core business of JBG Smith, right? So JBG Smith is a public REIT that primarily develops, invests in, creates mixed-use transit-oriented, highly amenitized commercial multifamily and office spaces with a significant amount of retail in big ways. It's a placemaker, and the workforce housing business is a very different business. So we wanted to be able to draw that distinction for investors as we were capitalizing the workforce housing business, as well as again in the investment sales market when we're out pursuing investment opportunities targeted at the workforce space. At the same time, the platform that JBG Smith provides that we're able to leverage at Leo Impact Capital is a tremendous asset. So we didn't want to completely disassociate the workforce housing business from the core JBG Smith business. JBG Smith's logo is the lion, and so we called it Leo Impact Capital, which is Latin for lion, as a way to maintain that link and communicate our ability to draw on some of the resources of JBG Smith, really to help us kind of punch above our weight class when it comes to impact investing.
Got it. As you mentioned, WHI Washington Housing Initiative was first introduced in 2018 with the idea of pursuing a private solution for housing affordability. So WHI is comprised of the Impact Pool, which is a for-profit investment vehicle, while the Washington Housing Conservancy is the nonprofit organization that's really focused on the affordable and workforce housing space and preservation. Could you share some insights on why you all chose this original organizational structure and what about it has been most successful?
Yeah, so going back in time, JBG Smith's the largest private real estate operator in the Washington, D.C. metro market. And one of the things that we kept seeing was this lack of production for middle income, households. And so trying to think about how can we address that, both from a social impact perspective, but also because, again, when we were seeing an increase in high income population, an increase in low income population, and a decrease in middle income population in Washington, D.C., at the same time that D.C. had the highest intensity of gentrification of any market in the United States, the conclusion was basically this is not healthy for the long term for this market. And as the biggest private real estate player in this market, it's probably not good for us. So let's see if we can find a way to address this. Ultimately, where we thought we could be additive was in this middle income space. There are a lot of very high capacity, low income housing tax credit developers, nonprofit affordable housing developers. Didn't need another player in that space. And obviously the market is the market. And so as we narrowed in on trying to address the middle income space, we realized that we wanted to raise private capital at scale and to create a model that was replicable, because we thought that's how you really move the flywheel in terms of changing affordability in the market, is if you can sort of draw private capital towards it. And so that led to the formation of the Impact Pool, which is this impact-focused investment fund that we created. At the same time, we wanted to try to drive long-term affordability. And so the Impact Pool is a closed-end vehicle, right? The investors in the fund want the return on their capital in a fixed period of time. We wanted long-term affordability, and so that said, okay, if we can have nonprofit, mission-aligned owners of these properties that we can finance, then that's a way to create long-term affordability with shorter term capital. We looked around and surveyed the landscape. We didn't see any nonprofit affordable housing developers who were both regionally focused, so looking at the market level as opposed to jurisdictionally focused, and we didn't see any who were particularly interested in middle income housing. And both of those have good reasons, right? Because the subsidy has been in the affordable housing space, and so that's where, just like any other business, nonprofits follow the money, and so they're in the low income space because that's where the subsidy is available, and the jurisdictional focus because a lot of what fills out the capital stack for affordable housing developers are local soft subsidies, and so it made perfect sense that they would be focused on one jurisdiction and that they would be focused on low-income housing, but that wasn't what we needed. So we thought, okay, we need to have a nonprofit owner who's focused on the broader market and who's focused in the middle income space. And so we partnered with a local civic group called the Federal City Council to help incubate this nonprofit called the Washington Housing Conservancy, which is fully independent of JBG Smith. And that became a nonprofit focused on owning and operating middle income housing. And then we would capitalize their acquisitions and investments with the Impact Pool and support the operations and asset management of their properties with our platform. And so that was the model that we developed.
Yeah, and so in the discussion on the soft subsidies being at the jurisdictional level, being that Washington Housing Initiative and Leo Impact Capital operates within the DC metro area, you've got Montgomery County, you've got, Prince George's County, Anne Arundel in Virginia, you've got Arlington County, the District of Columbia as a whole. How does operating at a regional level, complicate the process of identifying those soft subsidies and finding a way to make that capital stack competitive?
Yeah, so I'd say one thing, that the middle income space, workforce housing, requires much less subsidy than conventional affordable housing. If you just think about the cost of operating an apartment is essentially the same across all income bands. A little bit higher at some areas, a little bit less, but it's basically the same, right? And the cost of building an apartment is roughly the same, although ironically, low income housing often costs more because the soft costs are exponential there. But from a hard cost perspective, it's roughly the same. And so if we're talking about, rents in middle income housing that are between the market and the affordable, the subsidy required is much less. And so that's why things like tax abatement are very powerful for us, because you don't need tons and tons of ongoing operating subsidy to successfully operate these properties the way you do if you're only collecting, $500 a month in rent from a very low income household. But having said that, your point is 100% correct, that subsidies come from the local level. And so we spend a lot of time working in partnership with the governments at the various counties, municipalities, to try to create programs that we can utilize to acquire and operate middle income housing effectively. And so a lot of that does tend to be on the tax policy side, again, real property tax abatement side. But we've just had to go jurisdiction by jurisdiction. Actually, in Maryland, we've had to first start with the state because it wasn't clear that tax abatement for middle income housing was actually allowed under state law, that the local jurisdictions have the authority to grant it. So we had to get that cleared up at the state level and then work with the individual jurisdictions to try to create programs to allow them to do that. So a lot of our time outside of the real estate space is actually spent in policy, trying to create a policy environment, because again, we're less interested in securing subsidies for individual projects that we're doing than creating a platform that's scalable and replicable. And that's particularly important for us because our primary focus is buying market rate properties and converting them to properties that have a portion of committed affordability. And so we need to be able to move at the speed of the market. And so we need to then have a policy environment that is a bit underwritable by senior lenders and predictable for us to do that work at scale, and that others can jump on as well. We have this mantra that we call open source, where everything that we've done in the Washington Housing Initiative, we've tried to be extremely public about. We've shared our fund documents with I don't know how many different folks in the hope of creating more investors in the space, right? Because to truly move the needle in a market the size of the DMV or in any of these large cities, you need more than one. You need more than one operator, and so we welcome, welcome competition, welcome additional players to the space.
So much of the impact pool financing comes in the form of subordinated or mezzanine debt. What are some of the benefits of this position in the capital stack, and how has your perspective on the deal structure changed since the launch of the impact pool?
So yeah, that's a good question. I'd say two things. It is structured as mezzanine debt, although it is much higher leverage than a lot of mezzanine debt. We always say to our investors, you're taking equity level of risk in this fund, because we'll go up to 95% of the capital stack. The key thing that the mezzanine structure allows us to do in partnership with nonprofit or mission-aligned sponsors is gives us a fixed exit. So there is a price and a time at which we can exit the deal. And that, again, allows for this notion of long-term affordability from the mission-aligned sponsor, but a short-term return of and return on capital to our fund investors in the closed-end vehicles. And so that was really, the mezz was a way to kind of square that circle of, okay, this is a loan, it's going to mature, it has a payoff amount, and then we're out. But we actually are imposing a covenant that runs well beyond our exit from the deal. And by working with mission sponsors, we're ensuring longer-term affordability. So that was the main reason for creating that structure in the Washington Housing Initiative. The one thing that we've learned as we've looked at taking our platform with Leo Impact Capital to markets outside of the DMV, the one thing that we've learned is that the mezzanine structure is actually a limit to how quickly we can deploy capital, right? Because it does require, I mentioned we'll go up to 95% of the capital stack. It does require 5% hard equity from the nonprofit sponsor. That's the most difficult money to raise because you're asking people to give it, to give it away. And so that actually becomes the gate on how quickly you can make investments. We would go further, but the senior lenders won't allow us to go further in the capital stack. And so as we look to grow, that's where we're looking at alternative structures where we are direct owners of assets, more conventional investment structures, and we're bringing in mission partners to help us and support those assets over the long run. But that's really been the thing that we've learned. The other thing that we've seen is that, going back to what I said about why the Washington Housing Conservancy was created, in most of the other markets that we've looked at, the story is the same in terms of there are, a bench of nonprofit or mission-aligned sponsors focused on the workforce space and looking at the market regionally as a market as opposed to as a political jurisdiction. And unlike in Washington, D.C., where JBG Smith has a nearly half-century history, we don't feel that it would make sense for Leo to try to create conservancies in other markets, to go into a local market and try to create a local nonprofit. Just doesn't really sit right with us. And so that's another reason that as we look at other markets, the investment strategy becomes a little bit more conventional, because we just don't see that universe there yet. Hopefully it will start to evolve in those places.
Yeah, so I guess you guys are thinking about, how this program can be replicable in other places. Are there any specific economic conditions or regulatory environments that could prove to be accretive for this type of program?
So for us, our focus is on acquiring existing assets, converting the majority of the units to committed affordability, and doing it in what we call high impact locations, so neighborhoods they're really great places to live and produce better outcomes for residents over time, and we also think preserve real estate value better. So it really, the model works in any growing undersupplied market that has an inventory of rental housing that's in high impact neighborhoods, right? And so those are really the conditions for our particular model to be successful. And that covers a lot of places, but it doesn't cover every place, right? It doesn't work in a jurisdiction that's shrinking. It doesn't work in a jurisdiction where there's not a supply of inventory already there that's been underbuilt, significantly for a very long period of time. It doesn't work in various places. There's a great website that was recently launched called Preserve NOAA by a group called the Preservation Compact out of Chicago. And one of the things that they did is they characterized, I think, the 50 largest MSAs across the United States by typology. And so they talk about what the NOAA, the naturally occurring affordable housing, the existing sort of middle income housing inventory looks like in all these places, and then lay out strategies for how you could go at preserving NOAA based on the prevailing conditions in those markets. And so that's a great resource I would sort of direct listeners to see what other strategies might work in other places. But our strategy, we think, can be implemented really in any large and growing market that has a reasonable inventory of multifamily housing.
That's great. So since the launch of the Impact Pool and Washington Housing Initiative in 2018, the Impact Pool has allocated tens of millions of dollars. It's over $100 million investment vehicle, multiple assets under management. What are some of the lessons learned about the process of managing affordable workforce housing, converting market rate housing to affordable levels in that time, and where has your perspective gone from that management style with all that experience?
I think that the two biggest lessons that we've learned, and one was a bit of a surprise, and the other was less so, but are one around the income certification process. So we do certify the incomes of residents who live in the units where we're restricting the rent. So again, we take a market rate property, we'll restrict half or so of the units depending on the property at various income levels, and then we'll income certify those residents. We do that. We phase that in over time. We do it as units naturally roll in those apartment buildings. But it has been more challenging to complete the income certification process than we initially anticipated. And I think the primary reason is that most of the organizations that are involved in income certification are coming at it from the conventional affordable housing perspective. So they're used to using the low income housing tax credit program or one of the HUD subsidy programs. And that is a very intensive and extensive level of documentation that's required from residents to certify their incomes. And that's, you could argue roughly commensurate with the level of benefit that they're getting. If you're getting $1,000, off on the rent or $1,500 off on the rent relative to the market, you'll put up with a lot of hassle, frankly. In the workforce space, the discounts to market, the average rent burden for a missing middle household is about $300, $330 a month. And so the benefit is lower. Our income certification requirements as a platform are lighter than the low-income housing tax credit program or the HUD program. But the folks that do income certification, it's been very difficult to get them to do less than they normally do. And so, we've started more recently to, rather than engaging traditional folks from the traditional affordable housing world to do income certification, we started with folks who have none of that experience and sort of train up as opposed to train down, because it's very difficult to get the systems to do less. It's very difficult to get the people to do less. And that has real ramifications for leasing and occupancy and financial performance of assets. If you're taking a lot of time or you're imposing burden beyond what needs to be imposed, it affects occupancy and leasing. And so that's been one. The other is we're very focused. I mentioned we're focused on high impact locations. We want to be in these neighborhoods that produce better outcomes for residents and have better real estate value. At the property level, we're also very interested in building connection and community because we think it creates more stability from an operating perspective long term, and it has real documented benefits for our middle income residents over time in terms of economic mobility. And we've tried a variety of different strategies in the way that we operate properties really to create more resident engagement. And that's one where we're still learning what is the right approach. We've done things that are all virtual. We've done things with significant amount of on-site staff. We've done things in a hybrid format, and trying to figure out sort of the right way to program and activate the properties is something that we're still learning on. We like to take ideas wherever we can find them and copy what other folks have done, but that's a space where there's not been a lot of work done, and so it's been hard for us to. We've had to do more experimenting ourselves than simply implementing what other people have already worked out.
So, we're here at MIT. Obviously, one of the biggest themes in our curriculum and our program and programs across the university are technology. In the 2023 impact report from WHI, Leo Impact Capital, you all shared some insights on your partnership with Isuzu, which is a rental payment reporting platform that gives tenants the opportunity to build creditworthiness through timely rent payments. What are some other ways you envision technology to support the preservation and optimization of workforce housing? You mentioned that you all are, doing a lot of work in understanding how to create more efficiency in your existing portfolio. But curious how you're thinking about that and where you think the technology will go.
We think technology is really crucial. We love our partnership with the Suzu because it benefits residents. It also benefits property owners by encouraging on time rent payment. But we've that platform has helped us to lift about 220 people from subprime credit to prime credit. So that's really impactful across a whole range of life outcomes for them. And it's all technology based, comes straight off of the rent rolls. One of the big picture trends that we see on the property operating side is that it's just becoming more and more difficult to staff properties, right? It's a tough job. It's a customer facing job. And like most customer facing jobs post COVID, a lot of people are saying, I don't really want to do that anymore. It's even more difficult the lower down the price point you go with the properties. And again, we're in the middle income band. We're not in the deeply affordable band, but it's harder to work at a middle income property than it is to work at a luxury property, right? And so we're always looking for how can we embed technology in the property operations to help us supplement for the fact that we're not going to be able to staff to the levels that we might want to staff, and that we're going to have more turnover at the property level than we have had certainly pre-COVID. And then on this resident engagement piece, that's also an area where it's very difficult to attract and retain talent to work on resident engagement. So we are looking at, I kind of mentioned this, we're looking at a variety of hybrid models where we're delivering activities, doing programming online, but also having folks on properties, a couple times a month to get residents signed up and engaged, to have a human touch point with them, but to deliver a lot of the programming, a lot of the engagement virtually as a way to leverage technology to supplement for the fact that it's hard to staff. The other place where we're really interested in technological solutions is back on the income certification side. We're using a little bit of technology today to collect data from people through their phones and run that through the screening tool to allow us to income certify them. But we'd like to get to a point where we can essentially just have their consent to scrape data, verify that their incomes are within a band, and then certify them and be done with it, right? It really doesn't make sense to me that that's how it works when you go to try to buy a cell phone. That's how it works when you go to buy a car. And yet we're asking people to bring in pay stubs and bank statements and, even if they PDF them and snap them with their phone, that's not really a technological solution. That's just using a camera instead of collecting the paper. We ought to be able to assess with reasonable certainty that you're over income, because I really don't need to know exactly how much you make. I just need to know that you're not over income.
Right.
We ought to be able to assess that using technology with reasonable certainty, with minimum invasiveness for the resident. That's the one area where I'd love to get. There's a privacy side to that. There's a technology side to that, but also from a compliance perspective, we have to get the regulators comfortable that we're collecting the information that we should be collecting.
Right. For the sake of time, we kept your introduction short, but it's important to note that your contributions exceed above your role at JBGS and Leo. You serve on, the Affordable Housing Advisory Council with Fannie Mae, the Workforce Housing Committee for the National Multifamily Housing Council. All those contributions and provide a unique perspective when it pertains to the national context of affordable and workforce housing. What's inspired you to pursue this thesis of social impact and housing affordability, and how is the current conversation at the macro level painting a picture for where you can contribute in the near term?
I think that for me, this is an area where I had, a set of experiences and skills where I could have real impact, and I just fundamentally believe, based on the literature that's out there, that if we can provide stable and affordable housing in great locations, that has transformational long-term impacts for residents, right? It puts them on a different and better trajectory over time. And so that's something that it seemed to me was very much in our power to do. and that the opportunities were there, and it was really just a matter of sort of marshaling the resources and organizing around doing that. So it's kind of a no-brainer for me, because it's an opportunity to do something that we've known works, and that we can do. In terms of what's exciting me going forward, the one thing you did mention, I also serve on the advisory board of the Randall Lewis Center for Sustainability in Real Estate. I'm going to be chairing that advisory board starting in January. And the intersection of sustainability and affordability is really an exciting place for me. One of the things that we do at Leo, we are not a green fund, we're not a green investor, but we do climate risk assessments and energy audits, basically sustainability reports for every investment. And so we know the range of investments that we can make in a property. And then we've been very effective at marrying that energy audit with our capital plan, and then with the state and local subsidies that are available to allow us to accelerate and expand capital investment into these assets in ways that also reduce their energy consumption, reduce their operating costs, improve the building health for the residents, and lower the utility burdens for the residents. And so I'm tremendously excited about opportunities to do more of that with these assets going forward. Again, we're not sort of on the cutting edge of green, but I think there's a lot of relatively low-hanging fruit that can be picked up to make buildings more sustainable, make residents' lives, quality of life better, but also reduce costs for owners. And so that's where I'm spending a lot of time and focus and hoping to do more. Beyond that, over the past 3-4 years, the conversation around housing and housing affordability has never been in my career more prominent. And so that's really exciting. I think there's a growing awareness of the centrality of housing affordability to economic growth and economic mobility, as well as to social stability and social impact. And so coming at it from whether it's from the social side or from the business side, the centrality of housing has become, I think, more widely understood. And there's so much innovation going on at the state and local level all around the country to try to create solutions designed to the local context that address housing affordability, both from a supply side, from an affordability side, all angles. And that's really exciting. And I think the more that we're in conversation with each other around those things, the more knowledge that boils up, the more that we see that there are some central themes that can be picked up and replicated in a lot of places, in a lot of jurisdictions. And so that's really exciting to me.
Yeah. Yeah. I think alluding to the sustainability and ESG goals as it pertains to the existing portfolio, I think, we had a note on, how you all reconcile this fiduciary responsibility for the impact pool, as well as the broader goal of social equity. I think thinking about those types of things is exemplary of that, right?
Yeah, we have what we call an impact framework, which are really a set of principles that guide how we operate. And within that framework, every element has both a social or environmental component, but also a business component, right? The things that we're doing that are good for residents and good for the property are also good for investors and good for owners. And I don't think those things are mutually exclusive. I think it's really just a matter of expanding the perspective a little bit and just being very intentional about where and how we invest and where and how we spend time and effort. But the sustainability work that we're doing, it's reducing carbon, it's reducing water consumption, it's reducing energy utilization. It's also improving NOI, right? It's reducing our operating costs. It's reducing the utility allowance, which gets a little bit in the weeds. But in housing affordability, we think about the total cost of living in a place, right? And so that's how we get to these burden numbers of 30%. And so if a person is paying more for electricity because the unit is inefficient, then there's less dollars available for them to pay towards rent without being rent burden. So if we can reduce the utility burden, some of that goes to the resident, some of that also goes to the ability to collect more rent. right? And we can also, but we're also reducing in places where we pay the bills, the cost of our, so there's all these things kind of work together. And it's really just looking for those opportunities to create, value for us and value for residents in ways that also support them either from a social mobility perspective or from a sustainability perspective.
Yeah. So the last two questions we wanted to ask here pertain to kind of the outlook of affordability and workforce housing, rentership, equity. 2024 and 2025 represent milestone years. We've got 90,000 LIHTC projects that reach their maturity on their compliance periods, at which point owners can choose to implement a mark-to-market strategy and eliminate the affordability requirement of their projects. What are some of the public and private strategies that LEO or affordable housing developers, owner operators are pursuing to ensure affordability remains? And how does LEO's investment thesis, fit into all this?
We see a lot of the LIHTC syndicators now starting to focus on preservation. So investing in these, what they call year 15 deals, raising separate funds to buy those deals and maintain the affordability. And you see major players, like Blackstone through BREIT, standing up platforms like April Housing to really go after that. And I think that's important because that inventory is at risk of loss. A lot of it also needs significant capital investment. We have continued to focus in the unregulated, naturally affordable space, primarily because we think it's underinvested in. There's not enough focus there. And also because most of the best located multifamily housing is in that naturally affordable space. A lot of the low-income housing tax credit properties are not in those high opportunity or not in those high opportunity neighborhoods. And so we think it's a both and. You've got to preserve the LIHTC units that are there, but we've also got to do more investment in this unregulated, naturally affordable space, which is, by the way, where most affordable housing lies. I think one of the real challenges for the industry is that it is easier to invest in the low-income housing tax credit preservation because the affordability regime is already established. The program is understood. If you are an impact allocator of capital, it's very clear what you're doing when you're buying a LIHTC property. When we come to someone and say, well, we're going to go and buy market rate apartments in these great neighborhoods, and then we're going to restrict affordability on the majority of the units, but it's going to be at this middle income level, and we're doing a lot of stuff that's not as widely done. And so it's just harder capital to raise. So that's probably one of the challenges to this NOAA preservation, this unsubsidized affordable housing investment. But I think it's a really important space because of the impact that it can have.
Yeah, and I think it definitely comes back to that idea of predictability and making sure that the benefits are underwritable to get to a place where it can be, more sustainable and more repeatable, right?
Yeah. One of the reasons that we're so focused on transparency is exactly that, because we feel like you really have to overprove the point, because there is, you have to be fair about it, right? This is a space that is ripe for impact washing, right? There's a lot of opportunity to just buy Class B apartments, and maybe you're not going to raise the rent for 2 or 3 years, and you're going to flip them out to another value add operator, and you're going to deliver great IRRs to your investors, but you're not really going to deliver a lot of impact. And so we feel like we have to be overly transparent with what we're doing. That's the reason that we put affordability covenants on properties. It's the reason we publish that impact report every year. It's the reason we do income verification, so that investors who are interested in that view this as a viable alternative to the low-income housing tax credit program. Because one of the things that program has going for it is it's highly regulated. Might argue a little bit too highly regulated, but it's highly regulated, and that gives investors who are focused on impact a lot of comfort.
Yeah. So, the goal in preserving affordable housing is to provide viable housing options for renters at reduced income levels in perpetuity. The higher rates, development costs, barriers to entry have really limited the growth in home ownership specifically and created a growing demographic of long-term renters. In many ways, long-term rentership eliminates the opportunity to build wealth and equity in housing, which may be a family's largest monthly expense. How is the national conversation around housing affordability addressing these issues? And does there have to really be a trade-off between supporting renters and enabling pathways to home ownership and housing equity?
I think it is a both and, but I think have to acknowledge that there are going to be a significant number of long-term renters by necessity who are middle income. Just given the cost of production of new housing, the pace of production of new housing, that's going to be a reality. And so one of the reasons that we focus on high opportunity neighborhoods and one of the reasons that we focus on this resident engagement is because those are things that have been proven in the literature to increase economic mobility for people. And we're very interested in how can you increase economic mobility beyond home ownership, because it's not a near-term attainable option for a lot of the renters in this middle income band. That's an unfortunate reality. And so I think we do need to think broader about this. Jenny Schutz, who's at Brookings and has written about this in a great book called Fixer Upper and in several academic papers, has said, I don't know that if we were creating de novo a structure to create wealth for people, we would do it through their housing. But that's kind of where we are. The reason that housing provides opportunities for wealth creation is primarily driven by scarcity, right? I mean, the physical asset depreciates. You guys learned that, I assume, at MIT. All buildings depreciate over time, right? And so the land is appreciating, right? And the land is appreciating because of scarcity. And so there are some sort of, this is much bigger issue, but there are some sort of fundamental questions about the long-term, very long-term sustainability of that model if you also want to have growth. And I think if you look at places like the upper Midwest, there's a lot of homes that haven't appreciated in those markets, right? Because the land hasn't gone up and the physical value has declined. So it's a broader discussion, but we're very interested in how do we create wealth, economic mobility for people outside of just home ownership, because we don't think that's going to be the near term sort of broad solution in a lot of cases.
Yeah, that's great. Well, AJ, I want to thank you so much for joining us this morning. I know your time is very valuable, so appreciate it. And if you're ever in the Cambridge area, we would love to have you here at the Center for Real Estate. But thanks so much for your time today, and hope you have a great rest of your week.
Thank you guys very much. This is great to talk with you.
Thanks to our listeners for tuning into another edition of Meet the Visionaries podcast. And please remember to stay tuned for future episodes by subscribing to our podcast or follow us on social media by visiting cre.mit.edu to learn more. Until next time, take care, listeners.